I'm not shocked that we hit that magic number and all of a sudden the big sell-off. So I'll leave it at that. Thank you.
These metals took off and tripled in value. Base metals. I'm betting it's well over 100. It may be between 100 and 200. And I think a lot of that's going to occur in a handful of months, 5 to 6 months.
Probably bang around here toward the end of the year. We'll get into fundamentally positive 26 with yield curve control, sharp rate cuts, a new Fed head, all this kind of stuff. And then I think that's the trigger to get you to what Michael just talked about, a blast through 50. If it goes up 80% like gold did in 18 months, we'll be talking $90 silver by 2027. So anyway, I tried to spit that out as quickly as I could.
Silver is standing on the edge of a historic transformation, not just another rally, but a complete revaluation. The market has spent decades confined to a price zone between $20 and $50, but the structure is shifting fast. With backwardation now visible in the futures market, where spot prices exceed future contracts, it signals a shortage of available physical silver, something not seen even in 2011. The technical setup is now mirroring what gold did before its explosive 80% move earlier this cycle. Once silver decisively breaks above $50, it could enter a new price reality between $100 and $200 within months. The combination of suppressed valuations, structural supply deficits, and systemic monetary stress is creating the perfect storm for silver's next phase. DavidMorgan, MichaelOliver, and CraigHemke break down the signals that mark the beginning of silver's quantum leap. From technical triggers to fundamental tightness, their shared view is clear. Silver is about to leave behind decades of manipulation and step into a new era of price discovery. The conditions resemble gold's breakout in late 2023, and when the momentum shift happens, it will happen fast. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Well, I think we're going to get through 50, and I think we're going to look at it in the dust at some point. But to be consistent, I have said over and over, as you know, that I thought we might stall out at 50 because it's such a psychological barrier. And we saw one increase in margin requirements. And I noted that. I think I retweeted it to Craig, if I remember correctly. And this is what they do. I mean, they keep increasing margin requirements until, you got to put up basically the cash cost for the commodity. And then you see the market fall off. We're getting that direction. I'm not surprised. I got let's say, I won't say angry, but a agitated member this morning. First thing I get up, I haven't even had my coffee. What the hell's wrong, David? Silver is at 51 and every one of my stocks is down. What I said was, look, normally the shares lead the metal. And this is the pros taking profits in the shares and selling it off. And it's like they get the memo ahead of everybody else. So I don't want to put on the foil hat too much. There are times where these markets do what they do because of the setup. And this is one of those moments. And I do want to show a chart later on, Elijah, but I just want to hand it over to my colleagues and hear them. And I'm not making this an I'm a right and, whatever, because I want to see a couple more days of trading. But I'm not shocked that we hit that magic number and all of a sudden the big sell-off. So I'll leave it at that. Thank you.
Okay, I think it's idiot selling. Our assessment technically is that silver is about to make a quantum leap to a new reality. It's not in a bull trend. It's in a total shift phase in its price zone that it's lived in for 50 years. 50 highs, basically 20 is sort of a low, and it just lived there forever. Go to the Federal Reserve of St. Louis, Fred, and you can punch up charts like lead or zinc and go back in price history. And they'll have a monthly close-only chart going back to the 1990s anyway. And you'll see that they lived in a zone for quite a few, decade and a half or so, both those base metals. And in 2006, very late that year, silver and gold were already in a bull trend at that point. These metals took off and tripled in value, base metals. And since then, they've come back down, but they've never come back down into that prior zone of reality. They live in a new zone of reality that is double or more on average for the last 10, 15 years of what it used to be back in the 1990s to 2000. Well, silver's still in that first range, okay, where it was from the 1979-80 high, the 2011 high. Gold's above the 2011 high, copper's above the 2011 high, and silver's still contained here? Give me a break, okay. We know the fundamentals. I don't try to keep up with them too intimately because that's not what we do. But the technicals argue to us that we're about to blast out of this range and not just have another nice leg up, but move into a price zone of new reality. I'm betting it's well over 100. It may be between 100 and 200. And I think a lot of that's going to occur in a handful of months, 5 to 6 months. We're waiting on one trigger. That's a spread relationship between gold and silver. And we run momentum studies of it as well. Now, everybody looks at the ratio, the 80, 70 to 1 type thing. We do it a different way. We divide silver to gold, express it as a percent. And right now, silver is about 1.2% of the price of an ounce of gold. That's extremely low going back 50 years. It's been over 2%. In 21 of the past 50 years, silver has reached 2% of the price of gold. And some of those weren't even bull market years. Okay, so we're very submerged, but there is a very clear structure on the spread charts. When you plot the spread chart, silver versus gold, there is a pending triple top breakout at 1.31%. So we're not far below there. When we cross that level, the same thing happened to its spread versus gold in 1979 and in the fall of 2010, just before silver went totally vertical. It went from like 20-something bucks to 50. Boom. All in a handful of months. The spread was the tell. And we're watching that. We think it's going to break through. And our momentum of the spread suggested even a lower level than that 1.31%, which is a prior double top. Will break out before that. And when we do, when that spread breaks out, I'm putting the seatbelt on. I think silver is the place to be for the next 2 quarters, and the move could be enormous. And you look back and say, oh, now I understand why. Supply demand's been tight, et cetera, et cetera. Market has been an irrational level for too long compared to other metals, for example, that have done the same thing, had a tantrum and moved to a new reality. Anyway, that's my major comment.
The most curious thing about where we've finished up here today, to get brought us to this point, is this, I've never before seen backwardation on the futures board. At one point this morning, the spot price was higher than every silver contract all the way out to September of next year. And at one point, more than $2 higher than the current front month, December. It's not something we've seen in gold. Gold has maintained about what you'd expect, about a $20 contango or premium to spot. But this big inversion, this backwardation, whatever you want to call it, in silver is telling us something. A lot of people think it's an evaporation of the free float available physical in London. We'll see. But that's something that we didn't have in 2011. And so then kind of adding this on to the last thing I wanted to say, Elijah, I think when last time we spoke, I started thinking about late August, early September, and I think we probably discussed this, that silver was going to go up to $48 to $50, but then stall for some of the reasons that Michael just mentioned, and David has mentioned, going up, great resistance at that level because it's been there a couple times before. But to me, the situation is not analogous to 2011 or 1980. It's analogous to gold back in December of 2023. And today's price action looks like the action in gold on the 1st of December. Gold had rallied on that Friday, the last day of November, and on the Sunday night, December the 1st, it took off in the first half hour and broke out above, the previous highs above 2100, and then was massively reversed. And the selling continued all day on Monday, and you had these wipeout reversal candles on the chart, and everybody threw up their hands and said, that's it. Gold can't make new all-time highs. We're going back down to the 200-day moving average, going to 1200 or going to 800, all that stuff. Gold took 90 days banging in there between, falling down to 1800, going back up to 2000 and 2100. Took 90 days banging up against her. And then once it broke out On March the 1st of 2024, it's now rallied 80%. That's, I think, analogous to what we're seeing here. Big reversals today, big, ugly candles on the chart. Every technician's going to be out there over the next couple of days saying, that's it, silver, it's dead, it tried again. Probably bang around here till the end of the year. We'll get into the fundamentally positive 26 with yield curve control, sharp rate cuts, a new Fed head, all this kind of stuff. And then I think that's the trigger to get you to what Michael just talked about, a blast through 50. If it goes up 80% like gold did in 18 months, we'll be talking $90 silver by 2027. So anyway, I tried to spit that out as quickly as I could.
Silver's long-standing imbalance between supply and demand is nearing a breaking point. Years of structural deficits have quietly drained available inventories, while industrial needs, from solar panels to electric vehicles, continue to climb. Even when recycling and mining are combined, they can no longer meet consumption levels. What analysts once called a natural corner is now visible on the charts. Industrial users are unintentionally cornering the market. Yet despite this, silver remains grossly undervalued relative to both gold and inflation-adjusted historical prices. The disconnect between physical demand and paper-based pricing is reaching unsustainable extremes. This is not speculation. It's the market exposing a decade of distortion. Once the physical market takes control, silver's correction toward fair value will be swift, violent, and long overdue. Let's get back to the interview.
This is a chart from Matt Watson. He's an analyst that does all the metals across the board based to exotics like iridium, which I know almost nothing about. So this is a chart showing silver demand, what he calls the low case. And the red line is all silver production, which means the black line, which is the mining. And the red line is mining plus recycling. And what you see from 2024 onward is that basically we're in a deficit situation based on industrial demand alone, and that we've been in a deficit for the last 4 years or thereabouts. Now, that's what Jim Dines used to call a natural corner. We've all heard about, ad nauseum, the hunts try to corner the market and all that. Well, what Dines said is there'll be a time where the market forces for industrial use only will corner the market. In other words, we won't be able to mine and recycle enough to meet the demand. Well, that's what this chart shows. Now, where I disagree with Matt honorably is the silver or gray bar on there shows investment demand. That investment demand is roughly 200 million ounces consistently from 2025 to 2050 for the next 25 years. Well, no one knows the future, but I contend that as we move into this paradigm, which is one of my main themes from day one when I learned about honest money, is that you can't print your way out of this mess, which means more and more people are going to be seeking real truth, which means real money. So those gray bars, you could double and triple them. And not to be too nitpicky, but the line at 2020 shows 200 million. That is incorrect. It should be up here where, if you can see my cursor, at about 1.25. Because in that year alone, the demand for silver in quote unquote physical terms was 320 million by the ETPs and the normal 200 million by retail, for like 520 million ounces in that 1 year on investment demand. So if we can do that in 2020, we can do it in 2025. So I think this situation is, Michael and Craig have said, and many of us, that we're getting into a new paradigm. I don't like to use that lightly, and I think Michael said it best. I mean, we're in a situation where reality is going to shine through on all the naysayers like I can't believe it. I mean, we get through 60, 70, people are going to view in the one-handed salute going, oh, I hated Morgan, or he's an idiot, and oh my God, look what's happening now. I don't have too many detractors on X right now. I'll put it there. I'll give it back to you. I'll quit sharing the screen. But and that's the low case, by the way. If things go higher for AI or EVs or what have you,
Recent years where the supply demand is the way it is and demand increasing, the supply is not, et cetera, And yet price hasn't responded in a real way. I mean, you think about dollar terms also. 1980, $50. In real dollar terms, where would it put us now? It's probably 250, okay? In the decay in the value of the US dollar, not relative to other currencies, but in real buying power. Even over since 2011, money supplies increased like 150%. Okay, has silver increased that much above the 2011 high? No. Okay, so there's all kinds of realities out there that we know exist. We scratch our heads and say, this is ridiculous. Okay, we do anyway. And we know when it changes, it could change in a way that is, well, we've seen it in many markets. We've been around long enough to see when a market gets overvalued for too long, it gets ridiculous. In hindsight, everybody calls it a bubble. Or a market gets suppressed for so long that people think, oh, that's a new reality. It's a piece of crap. We don't, who cares about silver anymore? And it suddenly says, I'm going to wake up. Markets make mistakes. Investors make mistakes in terms of allocation, proper pricing in relation to reality. These things happen. Markets aren't always rational. And I'm arguing that silver was irrational, especially for the last 10, 20 years, of not ever coming up above this base range high that virtually every metal in the world has done. And not silver? Oh, okay. What for? And now it's moving with gold now because it's a monetary metal. But when silver engages on the fundamentals, like the graph we just saw, it'll have its own life. And I think it's going to move to a new reality. And again, if you do a dollar conversion, $200 is not irrational whatsoever. And sometimes when markets are too irrational one way, when they correct the other way, they overcorrect. Okay, you go way beyond what the new reality might be in silver. Maybe silver's going to live in $100 to $200 range for the next 10, 20 years. But it might reach 200 and fall back to 150. You'd get my point. And there's a new reality. The technicals are arguing for that, especially the long-term momentum technicals and the spread relationship to gold. Argues that silver, just to go back to its normal reality, let's say 2% of the price of an ounce of gold, which it's been 21 of the last 50 years. You've seen it at that level. In bull markets, silver spread to gold goes above 3%. In 1980, it went to 6.5%, the price of gold. But let's say it just goes to 2%. Well, what's 2% of $4,000 gold? Okay, what if gold goes, and we've been arguing this, and does what it did twice before? It had bull markets in the last 50 years, both of which were 8-fold gains, bear low to bull high, under circumstances that are far less dramatic and earth-shaking than what we have building out there now. If gold did it again a third time, had another 8-fold move, we'd be 8,500. Well, what's 2% of that? Okay, you get my point. Silver's going to move into a new reality. This selling at 50, I love it. It tells me the idiots are still there. They stick a nickel in front of a freight train, and they got, quote, overbought situation on a short-term basis, but they don't see the larger context. And it wouldn't shock me that when we finally go through 50, we have a situation where we close one, we're talking futures now, December futures. They're 47 something right now. They were up to just below 50 today. When they go through 50, it wouldn't shock me, and I'm not predicting, I'm just saying this would be justice. You close one day out at 49, next morning you open $3 higher, limit up or something, because force majeure, something going on, one of the fundamentals kick into gear, and suddenly you don't give these guys a chance to stop out of their short position. They put on at 50. You nail them to the wall. So I love seeing the selling at 50 because it tells me the idiots are still there.
I mean, everybody calls it the ratio of 80 to 1. You're just talking about 1.2% of price, which is basically the same thing, right? And I'm in Michael's camp. I think it historically has to narrow, but that ratio is a reflection of the derivatives that we use to price this stuff. And that's why it's gotten so out of whack over the years. So will that derivative pricing scheme fail? And that's the thing that, at least as of a couple hours ago, had everybody's attention, because that spot price had so diverged from the futures price. I was watching last week when this first happened, and about 20 cents worth of backwardation, if you want to, and whatever you want to call it, where the December contract was 20 cents cheaper than spot. It happened last Thursday, and it preceded about a $2 drop in the futures price. And then it happened again Sunday into Monday, and it preceded about a $1.50 drop on Tuesday. Each of those previous little 20-cent things, I watched it in real time. It happened through heavy selling of the futures contract. Today, when it widened to $2 plus, that was clearly buying of the spot. I mean, you're going to widen that thing out one or two ways, selling futures or buying spot. And you're going to narrow it by buying futures or selling spot. So it widened out today by buying a spot. And there's a lot of talk about, is there any liquidity left in London? What's the free float? Is it 150 million ounces outside of what's in the ETFs? Do the banks have that physical silver available to settle trades in that physical trading hub? I mean, there's a lot of questions about that. I mean, is that what you're seeing? And so there's a current part of this that remains unanswered, regardless of all of the, what we see on the hourly chart and that kind of stuff. It then consolidated for 4 months and then broke out at the end of August. And now at 4,100 this morning, that was another 15, 18%. So this is pretty predictable stuff in that regard. And that's why I don't think we're going back down, to some of the depths that, the perma-bears are going to come out and discuss in the next few hours.
Silver is standing at the edge of a new reality, one that's been quietly building for decades. Structural deficits, industrial expansion, and the collapse of paper-based pricing are converging to reveal silver's actual value. The fundamentals are undeniable. Demand is accelerating while supply stagnates, and inventories across major exchanges are vanishing. Each ounce is becoming more precious, more challenging to source, and more valuable to hold. As the global financial system stretches under the weight of debt and currency debasement, silver isn't just a commodity, it's a lifeline of real value. When physical shortages meet monetary instability, price discovery becomes explosive. Silver will move not just as an investment, but as a signal, a warning that trust in fiat money is fading fast. The time to prepare is before the market wakes up to that truth. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.